Good afternoon and welcome to Bulls, Bears, and the Bell. Thank you for joining us. We are diving deep today into really one of the most conflicting trading days we've seen in a while. November 6th, 2025. The market spent the entire day, well, pretty much on edge, didn't it? Ending with a sharp sell-off right at the close. But then, almost the second the bell rang, we got these corporate earnings reports that just delivered, well, a powerful counterpunch. It completely neutralized the panic, at least for a moment.
It really did. It was like the market was fighting itself. So for you listening, the big question we need to tackle is which story wins out here? Is it the huge fear-driven back rate panic we saw during the day? Or is it the cold, hard, fundamental strength from companies reporting after the bell? The micro story.
Exactly. That's our mission today, to really unpack this macro fear versus micro strength battle. It's created this perfect stalemate, really high stakes. We're going to break down the closing bell carnage, then dive into those, frankly, blowout earnings reports that stop the bleeding. And crucially, we need to figure out why one small piece of soft data has suddenly become maybe the most important number on Wall Street this week. Let's get into this volatility.
Okay, let's start with the damage from the main trading session. It was unambiguously risk-off. Broad selling in tech, which has been the market leader all year, really took it on the chin.
Yeah, 1.90% plunge in the NASDAQ composite. I mean, that's not just gentle profit taking, is it? What does that tell you about the conviction?
It tells you the selling was focused and pretty severe. The NASDAQ closed right down there at 23,053.99 and it wasn't just tech. The S&P 500 fell 1.12%, closing at 6,720.32. Even the Dow dropped 0.84%, nearly 400 points. When you see selling that wide, it suggests, systemic worry, not just shuffling money between sectors.
And you could measure the anxiety, right? We saw the VIX, the fear gauge, surge 11.60%. Why is closing above 20 so important for the VIX?
Right. That 20 level is the threshold everyone watches. It closed above 20.0. Historically, getting and staying above 20 signals a material jump in market stress. Below 20, things feel relatively stable, maybe even complacent. Above 20, hedging gets expensive fast, and it's clear uncertainty is taking over. You can almost feel the nerves in that number.
Okay, so the mood shifted from just stress to genuinely fearful. What lit the fuse? Our sources seem to point to two main things. First, that old debate about tech valuations came roaring back.
Yes, exactly. For months, the market sort of ignored warnings about the AI rally maybe getting ahead of itself, but that seemed to break yesterday. We saw really focused selling, driven by these worries popping up again that maybe the valuation bubble just isn't sustainable.
And you saw it right in the big AI names. NVIDIA, the poster child, down 3.7%. Amazon fell 2.9%. Tesla down 3.5%. Even stocks often seen as AI proxies like Palantir slid hard, down 6.8%. That's not just trimming positions, that's actively cutting risk.
And the second driver was, well, honestly, more chaotic. It's the vacuum left by this ongoing government shutdown. We're 36, 37 days in now? A record. And that means the market's flying blind without the official BLS data. No proper jobs report, no official inflation numbers.
Right, and into that void steps this private data point that was decidedly grim.
Precisely. The Challenger Gray and Christmas report. It showed U.S. employers announced over 153,000 job cuts in October. To give you some context, that's the worst October number since 2003. When there's no official data to argue back, a private report like that, especially one so negative, it just takes on huge importance.
And we also saw real-world fallout from the shutdown itself, didn't we? The FAA cutting flights.
Yeah, reducing air traffic by 10% at 40 busy airports. They cited staffing shortages, air traffic controllers not getting paid, and that immediately hit airline stocks. American, Delta, United, they all felt the pressure, so it was like a double hit. Really bad private labor news plus actual operational problems.
Which brings us to maybe the most interesting part of the day, psychologically speaking. This idea of the market's broken reflex.
Ah, yes. The classic Wall Street saying, bad news is good news. The idea that weak data means the Fed will have to cut rates.
Did the market even try to play that game yesterday?
It did, but only for a moment. The initial reaction, in pre-market trading, futures actually ticked up a little when that grim Challenger report came out. That was the classic knee-jerk response. Bet on a Fed pivot maybe in December, weak jobs, slower growth means lower rates eventually.
But that optimism just vanished. Poof. Gone almost as soon as the regular trading session started. Why did it reverse so aggressively? Why lose faith in the Fed saving the day?
Well, the problem seemed to be the scale of the weakness. Those layoff numbers weren't just hinting at a slowdown. They felt too weak. Like maybe the economy wasn't just gently cooling, but actually heading for a cliff. So the market's thinking shifted. It went from pricing in a nice soft landing with some helpful rate cuts to suddenly pricing in a nasty hard landing.
So the story changed from the Fed will cut rates, everything's fine, maybe even a rally, to, uh-oh, the economy might actually be breaking, and rate cuts won't help much if earnings are about to fall off a cliff anyway.
Hmm.
That old way of thinking where bad economic news was somehow good for stocks because of the Fed, that link seems broken, at least for now.
Yeah.
We're in a bad news is just bad news mode, and it overwhelmed any hope about lower rates.
That fear-driven macro view is definitely powerful. But as you said, this is why the day ended in such a weird stalemate. If the economy was really breaking that badly, futures should have kept tanking after hours, right? Instead, nothing. Futures basically went flat. E-mini S&P futures down just, what, 0.04%? It's like the after-hour session brought this huge rebuttal from companies.
Exactly. The market was just paralyzed because the actual results, the fundamental data from companies, refused to play along with the panic narrative. The micro strength was a powerful counterargument. Okay, let's dive into that. Let's look at the actual corporate results. Take-Two Interactive, TTWO. This feels like a perfect example of real numbers pushing back against those AI bubble fears or consumer worries.
Oh, these results were fantastic. Take-Two reported net bookings, that's basically their revenue measure, grew 33% year over year, came in at $1.96 billion, which smashed estimates. And crucially, recurrent consumer spending Think subscriptions, in-game stuff that grew 20%. That shows people are still engaged, still spending consistently, not just buying a game once.
And they raised their forecast too, right, for fiscal 2026 net bookings. Second time they've done that.
Second consecutive quarter they've raised that forecast. But the real headline grabber, the thing that makes you ignore macro worries for a second, was the Grand Theft Auto, the 6th release date. It's official now, November 19th, 2026. The CEO basically said they expect record levels of net bookings in fiscal 2027 because of it. That's a massive, tangible driver you can point to.
Okay, so Take-Two looks strong. But if the Challenger report and that broken reflex had the market convinced the consumer was tapped out, maybe dying, how does Monster Beverage fit into that, MNST?
It just doesn't fit at all. Monster Beverage, on a day completely dominated by panic about job cuts, reports record Q3 net sales, $2.20 billion, up nearly 17%. You just can't square the idea of a collapsing consumer with record sales of, let's face it, premium energy drinks.
And it wasn't just selling more cans. They showed serious pricing power, too.
That's right. Their gross profit margin expanded significantly, up to 55.7%. That tells you they're managing costs and can pass price increases to consumers without killing demand. Plus, their international business surged over 23%. It's now a record 43% of their total sales. This is hard data showing a pretty robust consumer both here and globally.
So this clash, macro fear versus micro strength, it really proves what people have been saying, doesn't it? We're in a very split market, a stock picker's market maybe?
Absolutely. It's a market with zero patience for any perceived weakness. Just look at the huge swings yesterday. You had winners like Datadog up 21, maybe 23% on strong guidance, Snap up 10% after reporting, companies that delivered clear, strong, beat and raise results.
But the punishment for missing was brutal. Duolingo got crushed, down 27% on weak guidance. DoorDash dropped 15–17% because they warned about spending more. How do you justify spending more on R&D if the market chops off nearly a fifth of your value overnight?
It just shows the psychology right now. Investors demand perfection, immediate results. Any hint that growth might slow down or costs might go up, it gets filtered through that macro fear lens, and the assumption is the growth story's over.
And the prime example, maybe the poster child for this unforgiving market on November 6th, was Airbnb. Their report wasn't terrible, was it? But it seemed to hit all the wrong notes for the current mood.
Airbnb really highlighted how thin the margin for error is. Revenue actually beat expectations, came in at $4.1 billion. But the key number, earnings per share, it missed consensus. Printed $2.21 when the street expected closer to $2.29.
So, revenue beat, slight EPS miss, and the guidance for Q4 was just, okay, kind of in line. Why did that cause such a negative reaction for a name like Airbnb?
Because for a stock price for high growth, inline guidance feels like a disappointment. Investors need that constant beat and raise story to justify paying a premium multiple. The takeaway from analysts was pretty clear. This confirms it's a stock picker's market. If you don't deliver that perfect report, you get punished severely. And that, in turn, just feeds back into those hard landing fears we saw earlier in the day.
So we end this really confusing day in this perfect stalemate, and hanging over everything is this huge government shutdown-induced data void. We know the official jobs report for tomorrow is delayed.
Yeah, the market is basically flying blind, desperate for anything, any signal to break the tie. And because of that, the single most important piece of data tomorrow, November 7th, becomes the preliminary University of Michigan Consumer Sentiment Survey that's out at 10:00 a.m. Eastern.
It's wild, isn't it? That this soft survey data, usually kind of a sideshow compared to CPI or the jobs report, is now the main event. It's the decider in this macro versus micro battle.
The stakes are massive because right now, this survey is the market's best guess at how consumers are really feeling, how resilient they are. So the bull case is sentiment beats expectations. That validates the strong earnings from companies like Monster and Take-Two, maybe triggers a buy the dip rally. People breathe a sigh of relief.
But the bear case,
Yeah.
if consumer sentiment misses,
If it misses, well, that confirms all the pessimism from the Challenger report, validates the broken reflex, reinforces those hard landing fears. And you'd likely see an acceleration of the tech sell-off we saw in the main session. This survey is basically acting as a proxy for both the jobs report and a consumer health check.
we should probably mention, though, this data void isn't permanent.
That's right. The immediate focus is on this soft data point tomorrow. But the big official inflation numbers are expected the week of November 10th to the 14th. We should finally get CPI and core CPI on the 13th, then PPI and retail sales on the 14th. Those numbers will really give the Fed something concrete to chew on heading into their December meeting.
What a setup. The market's just stuck, balancing this overwhelming macro panic fueled by political gridlock and one scary private report against solid real-world corporate result showing the consumer, at least at the higher end, is still spending.
And that leaves us with maybe a provocative thought for you to consider. The very short-term stability of the entire market is now hanging on soft data, a survey of consumer feelings, all because the official hard data is stuck in political limbo. So when critical policy decisions, like what the Fed does with interest rates, have to rely on these kinds of proxy reports and sentiment surveys, how reliable is the market's decision-making right now? And what happens to stability? We'll see tomorrow if the consumer can indeed rescue the market from its macro fears.